Hello, everyone. My guest today is Matthew Prince. He's the co-founder and CEO of Cloudflare. Their mission is to help build a better internet. Today, the company runs one of the world's largest networks, powering more than 10 trillion requests per month, nearly 10% of all internet requests, and more than 2.5 billion people worldwide. Matthew, are you ready to take us to the top?
Absolutely. Thanks, Nathan, for having me on.
So my research team put in bold at the top of the notes, they said, Nathan, we read this Scott Sandell Rosewood NEA sandwich story, and you've got to clear the air quickly and ask the question everyone wants to know, which is, what is Matthew's favorite sandwich since he didn't touch them that day?
Gosh, I don't know what my favorite sandwich is. Maybe a good turkey sandwich on some good bread.
That's
San Francisco sourdough bread.
There you go. All right, let's jump into Cloudflare. What's the company do, and how do you make money? Is it pure play SaaS?
Yeah, so we have a really simple model where people pay us to help make their whatever they're putting online faster, more secure, more reliable, and more efficient. And we have over 10 million web properties, APIs, mobile applications that sit behind our network, and we run a network that literally spans the world, everywhere from not very exotic places like San Jose to Djibouti and all across mainland China, and it's been really amazing to watch the company grow.
So walk me through kind of the average. Someone listening right now, if they want to use you and they're not already, right? What would they pay per month on average?
So it really depends. We have a free version of our service that people can get started with. It's really designed for entrepreneurs that are just getting started, trying to put something online. Up to, we have companies that pay us over $1 million a year.
What's that minimum? Sorry.
A zero. So
okay,
free.
free.
There's a complete free version of the service, which we love our free customers, and they're great. And then it graduates up. So free $20 a month, $200 a month, and then higher from there.
If because Matthew, I know you have tons of products, tons of different cohorts. I don't want to go down every single story. I'm sure you're analyzing all of them. But if I forced you kind of into some kind of average, would you say generally $200, $300 a month, something like that is fair?
I think that, yeah, our business really splits into two halves. So we have what we think of as our self-service business, which are people who come in, give us a credit card and pay for the service. And that's going to be around $100 a month on average. And then we have what are mid-market and enterprise customers, which we have a traditional enterprise sales team for. And those will be, it really varies, but sort of starting at $5,000 a month and up from there.
That's great. I want to put this all on a timeline quickly. When did you launch the company?
We launched the company in September of 2010, so we're coming up on our 8th birthday.
2010, congratulations. You've also raised, chosen to go kind of the raise route versus bootstrapping. How much have you raised to date?
$183 million.
And why did you decide to go down that path? That's obviously a significant amount. There was a point where you said, you know what, it's time to raise, let's do it.
Well, Cloudflare was either going to be kind of a 1 or a 0. It was either going to be a company that didn't work, or it was going to be a really big company. And we knew that in order to build what we were doing out, we had to build a global network. So we own equipment in nearly 100 countries around the world, over 150 cities around the world.
You're talking physical hardware.
Physical hardware. So we're not running on top of AWS or on top of Azure or Google. We actually had to build the network out ourselves. That takes a significant capital expenditure. And so that was something that would have made this a very cost prohibitive business to bootstrap. That said, I think we've been incredibly cash efficient. We knew from the beginning that our business was about how can we process a byte of information cheaper than anyone else. And so we've always respected that cash, and I'm proud that we have still to this day, more than half of that still in the bank.
Have you leveraged those physical assets to raise non-dilutive capital from traditional banks that understand what physical assets look like?
Yeah, we haven't as much. We experimented with that a little bit, but the challenge with that is that because most of our equipment is deployed outside the United States, it becomes a lot harder to get traditional like equipment financing or otherwise, especially when you're at a smaller scale. Today, where we're at a much larger scale and we can actually talk to more sophisticated global banks. That's been an option that we've explored, but it's not something that we've prioritized today.
I'd like to dive more into kind of security and really what you guys are focused on from a technical perspective. But first, can you give me a general sense of scale in terms of what you guys are at now in terms of run rate?
I think the only thing that we've said publicly is north of $100 million, and we're well north of that now.
That's great. And what year did you break that number?
a couple of years ago now. I can't remember. I think that we got to the metric I remember is that we went from $0 to $50 million in, I think, 4.5 years, which puts us in some pretty amazing company with companies like Salesforce and Workday and others.
Yep. So that was, 50 million in ARR by the end of 2015 kind of time frame, right?
Yep.
That's great. I think it was also public. Your last round of finance. Well, when was it public, the valuation, when you passed kind of the $1 billion mark, and what round was that? Do you remember?
So we, again, I've always thought that entrepreneurs who brag about how much they raised or what their valuation are, it's sort of like if you brag about how big your mortgage is. It feels sort of distasteful, but we've said that we crossed over $1 billion in valuation in the round that we did in December of 2014. But one of the things that I think that we've always done is we don't talk a lot about the money that we raise or anything else. So every round that we've done, we've kept secret for at least 9 months after we did it. So the round that we raised in December of 2014, we actually announced finally in September of 2015. So it's I think that raising money is sort of a necessary part often of building a business like Cloudflare, but it's not necessarily something to be proud of. It just means that you didn't actually generate enough revenue yourself to cover the costs that you had. And so, I wish that more people would focus on, how quickly you've gotten to sort of break even, how quickly have you actually ramped kind of your revenue rates, because that's what really matters for a business.
Let's focus on that. So how fast are you growing today?
So we're growing still high double digits at the rate that we're at, which is really amazing. And
Can we put a min and max on that and say between 50 and 99% year over year growth? Is that fair?
That's right.
That's great. Which again, very difficult at the levels you're at. There was speculation you'd go public in 2017, right? Which ultimately I think you pulled the plans for. Why, when you talk about using capital to drive your growth and your business in an efficient way, whether you considered IPO or not, walk me through the pros and cons of using that in terms of a capital form.
Yeah, we certainly weren't considering going public in 2017, and I think that what we're really proud of is that we've built a real business that can be a standalone, sustained business. And, we run the business at basically break even today. And I think that as you get to a certain size, whether you're public or not public, you have a responsibility to run your business as if it is a public company. And so making sure that you have the controls in place, that you're doing the right auditing, the right other systems. And so those are things that
Matthew, there's a lot of bullshit though when you run a public company. It's stuff you have to do that is just like no entrepreneur who's creative thinking about how to solve security issues would ever want to spend a moment of his time thinking about.
So I'd push back on that. I think that there are reasons that you have rules, and if you're taking people's money and if you're taking people's time, especially, and trading that for equity in the company, then it's really important that you make sure that you're actually putting in place the systems and controls to run that business responsibly. And so I think that while it absolutely is the case that when you're there were 3 of us that started the business in a small office over a nail salon in Palo Alto, California. So, back then it would not have made sense for us to do full KPMG style audits. Today, when we're north of $100 million in revenue, we have over 700 employees. It's the right time for you to make sure that you've got, a responsible board with outside directors, to make sure that you're going through accounting and the procedures that are correct, that you're doing full audits. And whether you're a public company or not, there's a time that you've got to grow up, and sort of companies that sort of say we're going to be Peter Pan forever. I would worry about what's going on behind the scenes there.
Yeah, I have had other security companies on that are in the, call it $80 to $150 million ARR range, and when I ask them the question about the pros and cons of going public, many of them will articulate one of the only big pros they see besides the obvious capital is there's something about being public that communicates trust, and in a business like security that can potentially help you land and expand and retain enterprise kinds of customers. Would you generally agree that's the one big upside? And do you again see any big cons to that?
We haven't had. I think that's potentially something that people say that hasn't been something that has held us back. Nobody. I mean, maybe there would be some marketing benefit from being public, but again, I think there's actually a responsibility to an organization, to your investors, to create some liquidity. And I also think that, it's pretty amazing that you could have invested in an Apple or a Microsoft or an Amazon as a public market investor and had there be significant upside from there. I think this sort of allergy to being a public company is a disservice to public markets generally. And I think it was probably too easy. I was a securities attorney back in 2000. It was probably too easy to become a public company in the late 90s. It's probably too hard to do it now. And you want to have the right balance between those things, but allowing public market investors and not just venture capitalists or people who are accredited to be able to make angel investments be able to benefit from the innovation and the wealth that creates, I think is actually a really important thing for markets generally.
Yeah. We recently had David Scott on, who runs obviously For Entrepreneurs, a lot of data on SaaS companies, and Brian Halligan at the same time. And they talked about the challenges of deciding which variable pricing axes you would price your tools around based off the value that your users are getting. When I look at your site, it looks like those metrics for you specifically are a per domain cost, and the second measurable one, it looks like, are something you've maybe invented or branded called page rules. Are those accurate in terms of that's what allows you to kind of figure out how to drive expansion revenue? And how did you decide that those were the key metrics that you could tie pricing to?
Yeah, so I think great SaaS companies have three characteristics. They have a low cost of customer acquisition, they have low churn, and they have the ability to expand revenue from those existing customers. I would say we're really good at the first two things. Our cost of customer acquisition is remarkably low. Churn rate,
Matthew, sorry, can you maybe put some kind of number around that? What do you mean remarkably low? As a percentage or a fixed number?
Well, I think that more than half of our business comes from just straight inbound, no marketing involved, that is built around sort of the halo of the brand, word of mouth, and otherwise. We on a traditional marketing basis, we've been terrible traditional marketers. Like we've spent very little on, you don't see Cloudflare billboards on the 101 in San Francisco. We don't spend a lot on any of the traditional marketing channels, and yet every day, 15,000 new sites sign up for our service, most of whom heard about us with there were zero customer acquisition costs. As you go up, for our larger customers, we've got sales teams that support those, but our sales team, our inside sales team is doing on average over $1.3 million in ACV on a per ramped rep basis, which is
over what period of time? That's new ARR per quarter.
Over 12 months, 1.3 million in new ARR per year, which is about twice what you would get from a high performing other SaaS company, where that's usually around $700,000 per fully ramped rep. And so that's we've been very, very efficient at being able to acquire customers. Our churn rates are very low. Again, it varies between the self-service business, where we don't typically lose to other competitors. If we lose self-service businesses, it's usually because they go out of business. On the enterprise business,
hold on, Matthew. Sorry, on the self-serve. So, would you say less than 3% logo churn per month in that cohort?
Yeah, that's around it. That would be around that, and then in the enterprise business, it's much less than that. And we have negative dollar churn and all the things that you would want from a business like that. I think the weakness that we've had in our business is that our expansion has been something which has been more challenging, and the reason for that is early on we said, we're competing with hardware, where you would buy a firewall, you'd buy a load
an on-prem kind of thing.
Yep, and you don't pay more for hardware if you get an attack versus if you don't get an attack. And frankly, if you're charging more when someone gets attacked, that feels a little bit like extortion. Yeah. And so we said you should have
prevented that in the first place.
Yeah, we wanted to make our pricing incredibly predictable. And so our original pricing was very, you pay us $200 a month, and it doesn't matter how large the attack is, we're going to make sure that you're protected. And so we have had to try to figure out ways to, either by adding features or building in things that are usage based, to get those to drive expansion. And I think that's very much the piece of our business that we're figuring out. I think we're better at it in the high end, enterprise and mid-market business. In the self-service business, it's been something that we're still working.
Well, Matt, and look, I've interviewed about 3 to 3 B2B SaaS founders. Maybe a sub cohort, maybe 5% are actually at your scale. Very rarely do you see a sub $100 per month price point where net revenue retention breaches 100% because the expansion opportunities don't exist. But it sounds like in your enterprise cohort, where you've got the sales machine ramped, you guys are well north of 100% net revenue retention annually.
Yeah, that's right. But I think there are opportunities for us to do that. I think that we took some things that used to be that people would price on a usage base. So we have a CDN like product that traditionally would be based on the sort of bandwidth used. We think that part of what's disruptive about what we've done is we've made that basically free across all our plans. That said, we now have effectively a private virtual network where we can get packets from one side of the internet to the other side of the internet faster, more securely, more reliably, and more efficiently than anyone else. And that's something that is a really unique asset. And so that's something that we are willing to price on a usage basis. And I think that's those new products are what will really drive net expansion dollars for our existing customer set.
Lifetime value can be a vanity metric. It's very easy to let that number lie to you when you start saying, well, it could be an infinity because our CAC is nothing, but here's how it works. Do you use lifetime value at all to drive your day-to-day decision making that are related to products, or not really?
I mean, to be honest, we haven't as much, largely because we have not been as traditional of marketers. Lifetime value is a great way to figure out how much you should spend then to acquire a potential customer. And so, it's something that, I'm sure we calculate as part of the business. We try and figure it out. But the challenge for us has been, I guess the opportunity has been that since we have not been spending as much on the traditional marketing channel, focusing on lifetime value has been less of sort of the focus for the first 8 years of Cloudflare's history. I think going forward, as we're becoming more sophisticated on the marketing channel, that'll be something that we think about. And then part of our challenge is it really is one funnel. Like sometimes people will start as a free customer. But then they take off. Like a major ride-hailing service in Europe started as a free customer as they started up. They then graduated to paying us $200 a month. They now pay us hundreds of thousands of dollars a year. And so trying to figure out when someone starts as a free customer what the lifetime value of that customer is that obviously is the exception. But getting those exceptions is a lot of what drives our business. About 25% of our mid-market and enterprise business actually graduates from the self-service business. And so that it really is one funnel. But because there's so much, our prices aren't 29, 39, 49, and we're sort of trying to, get people to move between that. 0 to 20 is a big jump. 20 to 200 is a big jump. 200 to 5,000 is a big jump. 5,000 to 50,000, 500,000, is a really big jump. And so it really is different segments of the business where we're trying to segment it based on the value that we're being able to deliver. 700
people. I assume they're based all over the world. I'm curious at your kind of scale. What is your direct report? What does your management team look like? How have you structured that?
Yeah, so we, the way that you, the variable that you turn up or turn down in order to determine how much hierarchy there is in an organization is how many direct reports can anyone have as a max. If you go to the Harvard Business School, they say the right number is between 6 and 7. We tend to think that we hire people who have a little bit more self-direction, and so we think the right number is between 9 and 10. I've got about 9 direct reports to me. My co-founder Michelle is our COO. So the people who would report to me would be our head of sales, our head of security, our CTO, head of product. Those sorts of folks are the people that report to me. And again, fairly traditional organization. I think we're a little bit flatter than some organizations because, again, we've allowed more direct reports per individual than some people do.
Yep. Last question here before we wrap up with the famous 5. Growing through acquisitions, you've done 4. How do you think about acquisitions, and is it something you're looking to ramp up? You're currently on the hunt for additional acquisitions that make sense?
I would say that every acquisition that we've done, the first and foremost question is there real are there individuals and real talent here who we feel will be we'll be able to contribute to the team, fit in with our culture, and that would work out. Most of the acquisitions that we've done have been acqui-hire types of acquisitions. I think we've done 2 that have had a little bit of a technology component to them, but again, still very, very small teams, 10 or fewer people as part of that. Nothing so far in order to grow revenue. So I think we're always looking for smart, fully formed teams that we can kind of bring in and that they can then very quickly ramp up. And there's sort of 2 different ways that you can do technology acquisitions. I think the challenge with most cloud companies is we're so tightly coupled that it's really difficult to take an outside product and have it naturally fit into our ecosystem. So usually when we're doing thinking about technology acquisitions, it's what are things that are in sort of adjacencies that we don't have to deeply integrate into our technology stack, but they could maybe have some sort of benefit on the side.
Lettuce on the hamburger or ketchup on the hamburger or things in the sandwich.
Yep, that's right. As opposed to changing the underlying structure of the patty.
Yeah. Would you go ever? I mean, it sounds like a malware bites might be a very interesting lettuce to your hamburger, right? You keep the pattern structure, but that would obviously be a major deal considering, Marston's funding and what their revenue is at. Would you ever go try and pull off a $500 million or $1 billion, acquisition like that?
I think that's a very different that in that particular case is a very different sort of animal than we are. I mean, they're trying to protect their buyer would be different. What they're selling, what is effectively software that is a client software. These are all things that we would be terrible at doing. So that in particular doesn't seem like it. That said, there are plenty of people that kind of are around the space, and if we thought there was something that could be accretive to us, and I mean we're very rational about if we can buy something at a certain multiple and that revenue is worth a higher multiple for us, then that can make a lot of sense. But generally, I think that we are less likely to grow through acquisition than we are through products that we develop in-house.
Yep. Last round of funding, when was that announced?
It was announced in September of 2015, but we closed it in December of 2014. So we kept it secret for 9 months.
That's great. Yeah. So here's what I want to ask you. It's been many years. Don't tell me an amount, but have you already raised capital that you have not yet released and you're still keeping it a secret?
No.
None.
We haven't raised any money since December of 2014. I mean, again, we and we have still way more than half that round in the bank. So
great.
we have been very Michelle and I are little squirrels at heart, and we have I think a very healthy respect for capital. And one of my jobs is making sure that we don't run out of money. And the best way to do that is run a great business that has high margins.
Matthew, are you married?
I am.
If you went home tonight and told your wife and you said, "Hey, listen, we just turned down a $2.5 billion acquisition from Bezos," does she kill you?
No, she'd say, "Thank God." Every once in a while when I say, gosh, I might want to. Although she likes Jeff, but no. Anytime I've sort of said, I think at some point we might sell this, she says, "No, you're not allowed to do that," because I think that
she doesn't want you to have free time and be home, right?
Well, I don't know. I mean, she works as well, but I think that what we do is you don't get to do this again. We're in a pretty privileged position where we get to really influence internet policy globally. We get to work at a scale which is just unheard of. We built a business that is running along, and those are things that you don't get to do again. And so I think that she thinks that we still have some really good work to do on things like internet policy. It's pretty amazing that you think about a day in a life in my life. I get to talk to politicians around the world talking about ideas like network neutrality, and we're really listened to. We really get to influence browser design. We're working on things like encrypted SNI, which closes one of the real privacy holes in the internet. That's pretty rarefied air that we get to breathe, and I think that she's really proud of the work that we're doing, and and doesn't really think that I could do it again.
And real quick, sorry, bullish or bearish on things like Bravo, right? These crypto kind of related things in your space.
I don't even know what that is, but so tell me more what that is, and I'll tell you what.
Hey, no. It's obviously a bad question if it's not on your radar. It would be on your radar if it was important. So we'll skip it over. We'll skip over. But generally, crypto as it relates to security and decentralization in your space, is it something you're thinking about, or no, not really?
Well, I mean, I think if I wasn't the CEO of Cloudflare, I'd be worried about Cloudflare because we are a centralizing force, and I think that the internet goes through waves of technology in general goes through waves of centralization, decentralization. Jim Barksdale, one of the co-founders of Netscape, said there are only two ways to make money in technology. You can either bundle or unbundle. And so, I think it is obvious that there will be great forces trying to figure out how to unbundle who the leaders are today, and whether that's Cloudflare or Facebook or Google or otherwise. That history doesn't stop, and so it's something that we're watching. I think it's smart that Mark over at Facebook is thinking about that. I don't know whether it's going to be crypto in any of the forms that it is today, but I do think that something decentralized is important, and I think that is likely to be disruptive to a number of companies that are very successful today, including potentially ours.
Yep. All right, let's wrap up here with the famous 5 quick answers. Number 1, favorite business book.
I was a student at Clay Christensen's, and so I think Innovator's Dilemma.
Number 2, is there a CEO you're following or studying right now, an off the radar one?
Off the radar. I really admire Bezos. He's obviously not off the radar. But I think I think that's about the most off. That's about the most on the radar thing. Who off the
Someone
radar?
where just they always give you something new to think about when you meet, but just no one really knows about them.
The founders behind there's a company called Scout RFP that they're doing just incredibly boring work on helping improve the RFP process. I love people who do sort of boring companies. I don't do much angel investing, but I put a little bit of money in their company, and Stan and Alex over there I think are just really smart, grinding entrepreneurs that are doing unsexy work in what is a really big space.
Number 3, what's your favorite online tool?
Favorite online tool, Twitter.
Twitter. Okay, interesting. A Twitter fan. Good. And what's your situation? Sorry, how old are you?
How old am I? 43, I think. 43.
And how many?
44.
That's exciting.
In November.
Good. And how many hours of sleep do you get every night?
7 to 8.
Any kiddos?
Nope.
All right. Last question. Take us back to your 20-year-old self. What do you wish you knew?
My 20-year-old self was a lot smarter than I am today. I think that don't take yourself so seriously is probably good advice. And all the sort of weird random hobbies that you have on the side are actually going to pay off. So keep investing in them. Because tinkering and hacking on things actually turns out to be a pretty useful skill later in life. Guys, there you have it. Cloudflare founder Matthew Tinker. It's important. He tinkered his way in 2010 into launching Cloudflare. Now today, they've raised $182 million, but more importantly is to understand again how they've been able to drive growth in an efficient, effective way to solve a real problem. They went from 0 to $50 million in their first 4.5 years by 2015. Today, again, growing between 50 and 100% year over year, and these are much larger numbers, doing north of $100 million per year today. Again, ARPU in the self-serve market that they've got about $100 in that same cohort, less than 3% gross logo churn per month. When you go to their enterprise cohort, you've gotten well north of 100% yearly net revenue retention, which is healthy payback period. Team of 700 folks based all around the world, again, focused on security and internet, really internet and shaping the future of what the internet looks like. Matthew Prince, thank you for taking us to the top. Thanks for having me on.